straight to you, Martin, if that's okay then.
Go to the good stuff first. Is that
Yeah,
it?
yeah, yeah, I think so.
Yeah,
Yeah, do
no worries
just
at all.
jump right in there. Yeah.
Yeah. Give me 1 second. I'll just share this now to. That coming through, James?
It
Okay.
is perfect, Martin. Thanks. Yeah.
Lovely. Lovely. So I'm just going to cover the part. This has cropped up quite a bit where Mary will go through the finer points and details of auto enrollment itself. But one of the areas that's caused some confusion and we're getting a lot of queries on is coming from employers asking about where they have existing employer pensions or PRSAs in place for staff and what does that entail? Or they're having a conversation with us and asking, well, if I have a pension in place, what do I still have to do auto enrollment or how am I fixed with that? So I'm just going to go through the reasons why we have a lot of employers making that query and are looking at setting up, if they haven't already, arrangements for staff instead of doing auto enrollment, instead of doing the compulsory piece that's required under auto enrollment. So as part of the auto enrollment piece, existing employer pension plans, what the legislation states is that at present, an employee who has membership of an occupational pension scheme or an employer personal retirement savings account with any level of employer contribution will not be automatically enrolled in the auto enrollment system. So if there is an occupation pension or employer PRSA and there's a deduction showing on the wage slip for that, that's the look through that the body that's looking after auto enrollment called NAERSA will use. Mary will touch on their role later on. But they basically have a look back. They're using revenue to get a look back at pay slips to see is there an existing occupation pension or an existing payroll PRSA contribution being made by the employer or employee. Is that shown on the pay slip? And if it is, no requirement for auto enrollment. It's automatically excluded from it. So the questions then that employers and that we're having with employers and that is, first off, we're getting this conversation where we're asking employers, well, what's your opinion of pension provision for staff? We're seeing many that are sort of auto enrollment as being like a wake up call for them. And they're looking at auto enrollment and thinking, well, actually, we've been meaning to do something for some or all of our staff. And this is a reminder that maybe we should start looking at it now. So that leads to conversations then that we would have with them around the nature of their workforce. What sort of numbers do they have that qualify for auto enrollment? What's the salary like? What's the turnover like? What's the budget going to be for auto enrollment? And just sort of looking at that general information. The key to that information is in the next few questions. So one of the key areas is that if you have any employees that are paying income tax of 40%, that's a question we're asking employers, and I'll touch on the reasons why in the next couple of slides. We're also asking about if you have any employees who would like to save more for retirement. Now, that's a harder question for employers to know the answer to. Uh, some employees may have come to their employers saying, do you have pension provision? Can you do it, etc. Those type of questions could have come at them in the past. Certainly the employer will have the detail around the income tax situation at 40%, but that second question might be a bit tougher for them to answer. Do you have employees that would like to retire before the state pension age? Again, I'll touch on why. And then employees with longer term service, and that's an interesting one as well that we'll cover off as part of it. So the 40% income tax, in essence, the government top up to the auto enrolment scheme is the equivalent of a 25% tax relief for the employee. There's no tax relief within auto enrolment. Instead, the government contributes a third of what the employee contributes. So that's the equivalent of a 25% tax relief. Now, the conversation we're having with employers is that you have this compulsory cost. It doesn't make any difference to you whether it goes into auto enrolment or it goes into an occupational pension, but it can make a difference to the employee And those at 40% is a classic example of that. Because if I'm paying income tax at 40% and I'm not getting tax relief on the contributions I'm making under auto enrolment, I'm losing out on that 40% relief. Whereas if the employer sets up an occupational pension instead, and I make my contributions that way, then I am accessing that relief, and that's worth 15% more to me. So employers might find that they might opt for auto enrolment, but they might get a tap on the shoulder from one or two employees that are at that 40% saying, can you do it the other way for me, please? Because it would be much better for me, and it's no difference to yourself. So that's a key area. Employees who want to save more or retire early, the key part to this is that auto enrolment has no flexibility. There's nothing there built in at the moment. The retirement age is fixed at the state pension age of 66. So for example, if you have an employee who wants to finish work at 62 and access their pension funds, if it's in auto enrolment, they won't be able to. If it was in an occupational pension scheme, they could access it. Contributions cannot be increased by the employee under auto enrolment. So it's set at 1.5% at the start, will rise to 6% over the 10 years. But if an employee feels, actually, this is an opportunity now for me to catch up on saving that I haven't done in the past, can I contribute more? The answer is no through auto enrolment. You would have to do that outside of it. Whereas within an occupational pension, you can determine your additional voluntary contributions that you want to make. And then I mentioned the long-term service. So typically when we talk to employees in situations where the employer is considering a pension, we might get the situation where the employee feels, actually, it's too late for me. I'm at that age now. I didn't do anything in the past, and I'm probably gone past the time now where it makes any sense to do it now. But what I want to do here is give an example of somebody, age 52, working in a company for the last 7 years. And for the purpose of the example here, this employee has a salary of 40,000 per annum. I'm going to assume that the normal auto enrolment standard contributions over the next few years happen. I've got inflation running at 2%, and I've got an investment growth rate on those auto enrolment funds at 4% per annum net. So we're running up to age 66, the state pension age. And if I ran those numbers that way, what I'll find is that I'll have an estimated fund of about 78,000 at that point. Because of inflation at 2%, the 40,000 salary goes up to 51,000. And why that becomes important is this, is that under an occupational pension, if you've got 20 years service or more, you can access your pension fund through a lump sum of up to 1.5 times your final salary. So typically pension funds, 25% of the pot is the tax-free lump sum. But for occupational pension, you have this additional option where if it works better for you, at 1.5 times final salary can be your lump sum. And in this particular example, if I have my final pot of 78,800, under auto enrolment, I've got to take 25%. That's the maximum. So I'm getting 19,000 of that as a tax-free lump sum. The balance will be subject to income tax as I take it. Whereas with an occupational pension, that same pot, I can more or less take all of it as a tax-free lump sum. So I've got this long-term service employee, maybe a little older, in their mid-50s, coming towards the end of their working life as such, feeling maybe that they shouldn't be involved in, or it doesn't make sense to be involved in, but actually structuring it for them under an occupational pension can allow them to take all their funds back tax-free from the pension pot rather than just a quarter of it. And then there's a consideration as well for employers. So under an occupational pension, there's what's called a vested period. And this refers to the minimum length of time that an employee must be a member of the scheme before they become entitled to receive pension benefits from it. There's no vested period with auto enrolment. If you have an employee starts with you on the 1st of January, you include them in auto enrolment. If they leave 3 months later, any contributions you made into auto enrolment as the employer go with them. If you have an occupational pension scheme, you can have a vested period of up to 2 years. So you could have it at 6 months, maybe for probation, getting people past that. You might have it for a year, but maximum is 2 years. And in essence, if the employee leaves the scheme before they complete the vested period, they're entitled only to a refund of their own contributions minus the tax, their own income tax. The employer contributions are refunded to the employer. So that's a consideration that we've seen for a number of employers that may have a transient workforce who see pension as an occupational pension as an opportunity to reward longer term service, and those that stay with longer will have the benefit of the occupational pension then and the contributions made by the employer. It brings an element of protection as well for the employer on cost, that if people have left, that those contributions are coming back with them. So that's certainly a consideration for employers when they're looking at alternative options to auto enrolment. So when we look at the two side by side, Mary will cover off the eligibility. Employees aged between 23 and 60 and earning over 20,000 from all employments are eligible and are automatically enrolled. Contribution rate start at 1.5%. Vested period, there's none for auto enrolment, no AVCs, no single premiums, there's no tax relief. There is the additional government contribution. Retirement age is at state pension age, and they estimate that charges will be at about 0.5% per annum. That's what they're looking to cap it at. A company pension, the employee is not included in a company pension scheme where if you're not in that, you'll be automatically included in auto enrolment, but otherwise the employer sets the eligibility. Contribution rates, employer sets that as well. Maximum 2 years vested period. AVCs, single premiums, all allowed. Tax relief is there as well to give some relief for employees and their contributions, particularly those of 40%. Retirement age can be between 60 and 70 for an occupational pension, so it's not just fixed at the age 66 state pension age. And in fact, with an occupational pension, if you have left that employment, people can access pension funds, their older occupational pension funds from age 50 onwards. So, and again, we've seen that from time to time, but under auto enrolment, not going to be available to you. And then charges typically be agreed between the employer and trustee. So look, that's the sort of side-by-side differences between the two structures. The considerations then for employers, auto enrolment means you're going to have to contribute. It's compulsory. It's coming in on the 1st of January 2026. Make sure you've budgeted for it. You need to budget for the cost that's coming through, but also be wary and conscious of the future budgeting costs, because that 1.5% contribution is looking to increase, as you know, up to 6%. A lot of employers want design oversight, though. A lot of them are talking to us about, well, can we put a structure in place for staff that are with us for 5 years or more? Can we make sure that we include senior management? Can we make sure we include people who are with us for 2 years, or whatever it might be? But they want that control over who they have included in occupational pension. They want that flexibility to tailor that scheme. And then they're using it to retain, should I say, and attract valuable employees. So it's very much being used as, well, yeah, auto enrolment is the minimum 1.5%. We can do differently. We will do more. And we're seeing contribution levels of 3, 4, 5, 6% coming through from employers then that are doing that for their employees rather than going with the basic auto enrolment route. So look, the actions then we're saying to employers is figure out what's the best option for your business. What's best for the business, for the budgeting, and your future plans? What's best for employees? If you have employees with longer service, if you have those on 40% income tax, you've got to make a contribution. Maybe it's better you put that contribution into an occupational pension for them instead and giving them better options and better benefits through that scheme. If you have existing arrangements, review those to make sure that they will be included, so that if you don't want auto enrolment kicking in because you're already making the arrangement, make sure you have the proper payroll deduction facility in place and it's showing in the pay slip. And make sure, obviously, you've got that payroll deduction capacity then to deal with that. And what we're seeing from all of that is then that the results are, like, I get employers asking, so what are others doing? And it's a mix of everything. Some are continuing on with auto enrolment. Some are setting up occupational PRSAs or master trusts for individual members of staff. Some are setting up a group pension scheme to capture all staff. making sure there's AVC or AVC, additional voluntary contributions or AVC PRSA is available as well. And in some cases, is a mix of auto enrolment and some of those options as well. But as I said, the key part is what's best for the business, what's best for the employees. Make sure to check on that. So that's me for the moment, James. Thanks for that.
Thanks, Martin. Thanks very much. Very comprehensive. Just before I hand over to Mary, who has sorted out her technical glitches, I'd be glad to say. Just a couple of questions in there, Martin, I might put to you there if that's okay. Diana there, first of all, directors, PSI Class S, not included in this. What options do they have?
Yeah, not included. That's
yeah.
part of the look back and look at payroll, and if it's Class S1, if they're not under, if they're under the age of 23, over the age of 60, the 3-month look back, I believe, and Mary probably covered this better, helps them to aggregate or pro rata to an annualized basis what the salary is to see if they're over the 20,000, and then is there a payroll deduction for occupational or pension or PRSA. If you're outside of any of those, you shouldn't get notification from NAERSA that the employee is to be included.
And just before I bring you in, Mary, maybe to add to that there, just options. Options are huge there for directors then around what their company can fund into their pension then as well, Martin.
Yeah, that's for directors themselves. Yeah, we find that the conversation might lead to that. Now, directors are notorious for looking after themselves last, the owners of the business and that. Yeah, but that's nearly a separate conversation as to what's best for them to do. So they might be Class S1. They're not going to be included for auto enrolment. But we are seeing some of them that because they're in the frame of mind of there's a few staff we want to look after, can we set up a scheme for them? The question is, what about yourself? You're looking after yourself as well. And yeah, there's options there to be able to fund past service and stuff like that, then to make sure that they've got a healthy balance in their pension then when they decide to retire,
Perfect. Mary, it might be the same question really, but from Edmund there, farming as a company and both an employer and an employee in my late 60s, is there any advantage to me enrolling? I might put that to you, Mary.
In their late 60s?
In their late 60s. Well, no, sorry, late 60s actually, yes. Yeah.
Late 60s. Well, if they're in their late 60s, they're exempt.
Yeah, and out. Yeah.
And if Martin wants to talk to us afterwards, I'm absolutely happy to talk to him. And I'm sure Martin Glennon would be too.
Yeah, perfect. Geraldine there, Martin, back to you, Martin there. Geraldine has asked, we have some employees for whom we make an annual employer contribution into their own PRSA. So the employees, I think in this case, are paying their pension directly. It's outside of payroll. But the company is putting a top up into same. Will they be enrolled?
My understanding is that, because that look back, and Mary's probably more the expert in this, but I'll give you my Ladybird version. NAERSA, which is the quango or authority looking after the administration of all of this, will get access through revenue to payroll information. And for example, they would have been looking at September, October, November, and the payroll for those months. So if there's no deduction for pension within the normal payroll function, if they're over the earnings of 20,000, if they're within the age range, and that employer is going to be notified that you need to include them for auto enrolment.
Okay, but there's an opportunity between now and the end of the year maybe to...
Yeah, but even the opportunity, because it's not... Each 3 months, it's like each month they look back at the previous months. So if there's still no deduction, there's still the requirement there. If there's no payroll deduction, it's going to be auto enrolment. And that particular example, there is no payroll deduction. It's a one-off that isn't being done that way, So
okay.
They're going to be...
There is a few more... Thanks, Martin. There is a few more questions, but I might just go to you, Mary, for your presentation before we go through the next round of questions there. So Mary McDonagh, Head of Payroll and HR Services at ifac. So a little bit more on the detail of auto enrolment itself, maybe, Mary. Yeah.
Thank you, James. I thought it was important to actually test you today and have the technical issues. Thank you, everyone, for joining us. We really appreciate it. What we're going to do today is just to take you through a clear, practical look at auto enrolment, what's coming, how it will work day to day, what employers actually need to prepare for, There's been a lot of discussion and quite a few questions around the scheme. So the goal of this afternoon is to make it feel maybe more straightforward and manageable, while Martin will obviously look at alternatives. I'll take you through the essentials, what it means for employers, employees, how payroll will handle the new deductions, and key steps employers need to take ahead of the employer portal opening in December, and that's early December. We don't have a definitive date. If anything comes to mind during the presentation, please drop it into the chat. So let's get started. We'll talk about what enrolment is. So with the basics, auto enrolment, it's a mandatory retirement savings scheme. The whole idea of this is to boost pension savings schemes across the country, especially for people who don't currently have any coverage. One of the big issues in Ireland at the moment is the pension gap. Lots of employees simply never got around to joining a pension. And with this system, anyone who meets the criteria, and I'll go through that in a while, doesn't already have a pension, will automatically be enrolled so they don't miss out. For employers, a big advantage is that you no longer have to set up and manage your own occupational pension scheme if you don't want to. And in most cases, obviously, employers would want some form of a scheme, but this is an option. The system is designed to be run at a national level with very little administration on an employer side. Once everything is up and running, most of it will flow through payroll automatically. So your payroll department may not agree, saying that it's going to be seamless. The core idea is to increase savings, reduce the gap, and make it as simple as possible for employers to follow through. Now, how it's going to work. Auto enrolment will operate in the same vein as the PAYE, PRSI, and USC. Once an employee has been identified as eligible, the deduction will be paid through payroll without exception. There's no option to opt in or out on that. The payroll instructions will be issued by NAERSA via an APIN. This will function similarly to how revenue currently transmits tax credits and RPN updates. So that ensures that in auto enrolment and contribution details flow directly into payroll systems as such. Given this, employers must ensure that their payroll software is prepared to accommodate these new instructions. And I have to say, payroll providers all over the country have been working closely with NAERSA and the Department of Social Protection, and I believe the technical design of the scheme is now complete or near completion. Overall, the intention is to streamline the administration for employers, with the process becoming largely automated once appropriate software updates are in place. And let's be real, it's a mammoth operation that is being rolled out here. So we expect that the first 3 months there will be a lot of tweaking, as would be with any major project, especially government project. Now we're going to look at who is eligible. So auto enrolment applies to all employees who meet the following criteria. They're aged between 23 and 60. And by 60, I mean 59, because once you're 60, you're opt out. But I'll talk about that later. They must earn 20,000 or more across all employment. They don't already have a pension scheme. Our contributions are not being paid through payroll. So that is answering one of the questions about the PRSA. They have to go through payroll to qualify for not to be auto-enrolled. If these conditions are met, you'll automatically be enrolled into the scheme without any action, or without exception, I should say. Employees who fall outside the criteria may still opt in. For example, an employee who might be under 23 or over 60, and whose earnings are below 20 can opt in if they wish. And that will be via the portal, which will go live in early January. Equally, an employee who's already contributing to the payroll is exempt from auto enrolment. So that's very important to note. Okay, so if you've already got an employee who is making a contribution to pension scheme and it is going via payroll, they will be exempt. There are also other categories, as Martin alluded to earlier, that are exempt, and they include the self-employed, directors who are in Class S, and also any family members who are employed using Class M PRSI. That is important. They will not be enrolled. Now, when we talk about company directors, some company directors are in a Class A. So if they are in a Class A, they will be enrolled if there is no pension, if they're not making pension contributions at this moment in time. Now, in as far as the rates are concerned, employers will match the employee contributions. That will always, and the state then will pay a top-up on the employee's contributions. And this is instead of tax relief, which you would normally get from an employee would normally get if they were contributing to an occupational pension scheme. Now, to help everyone adjust to and become accustomed to the additional cost, and let's be honest, it is an additional cost, contributions will be phased in for the first decade of the scheme. So they will start at 1.5% for both employee and employer, and will rise by 1.5% every 3 years until the 6% is reached in year 10. Now, obviously, the state's contribution will also increase. Now, to be really clear, though, this phasing in will only cover the first phase of auto enrolment, not the first 10 years of an employee's career. We've had questions on that. So all new employees joining after year 10 will start at 6%. All contributions will be calculated on employees' gross pay before deductions. And this means anything that's included in gross pay will be assessed for the contribution rate. And that includes basic, overtime, commission, BIK, etc. Whereas normally with an occupational pension scheme, it is usually just the basic pay and holiday pay that would be pensionable. But this, everything is, including BIK, and that is something to bear in mind. Now I'm just going to go to the next one, which is about multiple employers, and we're going to look at how that works. In the case where an employee has multiple employments. So, for example, in this case, we're looking at one job A. In job A, he's earning 10,000, or she, and job B, 15,000. What the system will do, or NAERSA will do, is based on information received from revenue, they will look at that and say, oh, this individual is earning over 20,000. They automatically qualify because there are no pension contributions being made for them. So they will automatically be enrolled in both jobs, in both roles. Now, if, for example, one of those is actually involved in contributing to a pension already, that job B, for example, might be making contributions to a pension scheme. In that case, that role will not be auto-enrolled. Now, revenue, it is important to note that employers won't have to look at who is eligible or not, because revenue obviously has visibility of all earnings. And NAERSA will issue the instructions confirming who is to be included in AE. So it just takes that pressure off most employers. There was a concern out there that they may have to identify who is eligible or who is not. Now we'll talk about how the My Future Fund is to be administered. It is, as Martin mentioned, NAERSA are been recently appointed. That stands for National Automatic Enrolment Retirement Savings Authority. It is a mouthful, and they will oversee the whole scheme. So they will manage the administration, compliance, communication, and the overall operation of the enrolment at a national level. So they're going to use payroll data supplied through revenue and to identify who's eligible. And what they're doing is they look back at the previous 13 months or 13 weeks and identify, is somebody earning over 5,000? Based on that, they will assume that their earnings for that year will exceed 20,000 and will automatically enroll them. Each employee will have a savings pot as well that follows them throughout their working life, and that's NAERSA will manage that. And if they change employer, the pot will move with them, regardless of what section, if you're moving from one sector to another or just moving roles. And finally, they will also look after the investment element of the pension fund. Now we'll go to the portals, and this is how really NAERSA are going to manage the operation of the auto enrolment. First, there's the employee portal, and this will go live hopefully in January 26, where employees will be able to manage their participation of the scheme, including opting out, opting in, contribution suspensions, and re-enrollment. And again, like I said, that will go live in January 26. We have not been notified of the date that it will go live. We haven't been made aware of that yet. The employer portal, now that's really important for all of us. We're expected that will go live early in December. And all employers, regardless of whether they believe they have an auto enrolment exposure or not, need to register for this. They will be able to register on the portal using their ROS credentials, and which means they will also be able to set up their payment arrangements ahead of the go live date. And we're encouraging all of our clients to opt for the variable direct debit, just in line with how they make their revenue payments on a monthly, weekly basis. So together, these portals form a kind of a core part of the administration system and will support, we hope, a smooth rollout of auto enrolment. Now, I have kind of spoken about how NAERSA will identify who is eligible. But like we mentioned earlier, there's going to be a 13-week look-back period, and that has been applied to determine whether employees meet the 20,000 annual earnings threshold. There was a concern that they would stop doing the 13-week look-back in November, but we now believe that they're also going to do this in December. Now, when they make this assessment, when they assess whether an employee has already got pension contributions being made through payroll, that will help them decide whether somebody is actually, eligible for auto enrolment to be, and that helps. A lot of our clients have had concerns whether if they set up a pension scheme in December, would it be recognised by NAERSA in January? We expect that it would be. If there is an overlap, the employer can apply for a refund via the portal in February. Now I'm going to go through those clients those employees who can opt out. Employees can opt out, but within a specific window. First, they have to remain enrolled for the first 6 months. And then after 6 months are up, there's a 2-month opt-out window. That's month 6 and 7, where they can opt to leave the scheme if they want. But just bear in mind, they will be re-enrolled after 2 years. And this will continue happening for a period of 10 years. The employee can opt out, but the employer cannot. Just to bear that in mind, because a lot of people have asked us that question. So how will the auto enrolment process work from start to finish? So employees are identified automatically using the payroll data, so there's no manual checking for employers. There'll be no waiting period. Once an employee meets the criteria and isn't already in a pension, they're going to be enrolled immediately. The employer's role is to make sure that the deductions are applied correctly in payroll. NAERSA will send the instructions directly to payroll, just like revenue does today. One thing to bear in mind, though, contributions are then collected from both the employee and the employer based on gross pay. That is something we just need to keep reminding ourselves. And also that those contributions will be debited after 6:30 p.m. on payday. So if your payday is Tuesday, 6:30 that evening, after 6:30, the account will be debited by NAERSA. No amendments can be made to payroll after that time, and NAERSA has made it clear that there will be strict enforcement, as this could, lead to delays and have an impact on investment. So that is something that they're really very concerned about. Full compliance will be required once auto enrolment goes live. The WRC will be overseeing the enforcement, so employers should ensure that their processes are in place from the start. The Minister, Dara Calleary, has indicated recently in newspaper articles that he is looking at introducing emergency legislation in the case where, to prevent, actually, I suppose, employers from creating an inferior pension scheme in order to find a workaround to avoid AE. So that is something we're definitely not encouraging. That would not sit well. And I would expect the WRC to throw the book at any employer who thought that they found a way around it. Now, what are the next steps employers should really look at? And they should audit, as far as I'm concerned, they should be auditing their current pension arrangements, look at the scheme that you've currently in place, and identify which employees you believe auto enrolment might apply to. I think it's, like Martin said, it's important to plan for the budget. Contributions will rise over the next 10 years, and it is important to model the cost and build into it long-term financial planning, because 6% is where we're going to be in 10 years, but we don't know where we're going to be after the 10 years. There's no indication that it will not increase as one would expect it would. I think it's important to review your payroll system, talk to your payroll provider, and make sure that your software will handle the auto enrolment requirements and the upcoming instructions you will receive from NAERSA via their APEN. I think it's very important. I expect that most Irish payroll systems will have that incorporated into their updates in 2026, but have that conversation. It is also important that you look at your communication strategy. Employees will have questions, and it is important that you prepare for them now. And get the message out that this is happening, because otherwise, if they're not aware that that they may be auto enrolled, there may be a lot of questions in January if they're not aware of it. And it will just make the transition for you and the employee much smoother, we hope. And I would also say stay informed, because they're constantly tweaking the system, and we should be looking out for, there's a lot of advertising going on at the moment. Government is doing some, and also NAERSA are constantly updating via updates there, whether it is on X, social media, and obviously newspapers, etc. I think the main message here is to start planning now. Preparation will make the implementation far easier. And as I suppose Roy Keane likes to remind us, if you fail to prepare, well, you know the rest. Auto enrolment is definitely one of those which, preparation will pay off. Back to you, James.
Thanks, Mary. Very comprehensive. A lot of good questions in. Just one I'll deal with there myself. Is there a video of the content here available? There is. I think that was Lorraine, and we can get that across to you, Lorraine, and it's there available, I think, after our call here today. Michelle has a question there. If you start and you're enrolled on auto enrolment, can you then switch to occupational pension? So I might, Mary, maybe you want to take that one.
Yes, you can. Obviously, if you are enrolled in an occupational pension, the first submission will go through to Revenue, who will share the information with NAERSA, and then they will issue an APM that says 0% contributions to come through. So perfect. Yes, you cannot.
Thank you. Kira's asked there, one employee under 20,000, do I fall outside of auto enrolment? I take it she does at the moment, but the employee could enroll themselves.
Absolutely, yes.
Okay, very good.
Yes, but through the portal, James, which will go live hopefully in January.
Okay, very good. An anonymous query in, and this is an important one there, and I might just take this myself. I'm working for my husband, sole trader, 58. Will I be enrolled on auto enrolment? I take it, Mary, from your presentation, Class M here would apply, therefore no enrolment onto this scheme. Would that be correct?
That would be correct, unless, of course, she's a contract of employment and she's on Class A. But if she's on Class M or S, she would be exempt.
Fair chances in a spouse, she's probably on Class M. For whoever sent that query in, just to consider your own state pension position. If you're not paying PRSI, how you're fixed towards your state pension then as well. So it's worth actually maybe having a chat with ourselves or your own advisor on that one to make sure you're covered on PRSI for state pension. Martin, I might come to you there then. Sharon asks, directors on PRSI Class A, pension is outside of payroll. Will they be enrolled?
If pension is outside of payroll, it won't get picked up. So therefore, Class A, they will be included in auto enrolment, provided all the other requirements are met. They're in the age-led bracket, they're in the earnings bracket. Yeah, then they'll get pulled into it.
Okay, very good, very good. Jürgen asks, and again back to you, maybe Mary here. Are there any minimum requirements for an employee to install auto enrolment? I don't. Well, I think Jürgen, I don't think there's. If you've employees that hit the criteria, you're going to be in auto enrolment. That's it, really, Mary, isn't it?
Yes, absolutely. And as an employer, he doesn't have to worry about it. They will inform him.
Okay, very good. Andrew, how are contributions calculated where pay is varied? So I think it's a bonus question, and pay is up and down, or hours might be up and down. It's a percentage of gross earnings in the week or the month.
Yes,
I take it. Yeah.
yes,
Okay.
it is, and like I said, which is unusual because with pension, with no occupational pension schemes, normally it is just the basic that would be that the percentage would be calculated on. But with auto enrolment, it is literally every pay element is subject to the 1.5% and it includes BIK.
Okay, very good. Sharon, good question here. Short-term cover, so 4 month sick cover contract. Is that covered under auto enrolment?
If she meets the criteria, yes. Yeah. Where she would be under 23 and 60, where she's already earned 20,000, it follows her. So yeah. It absolutely, yes. Just like the pot will follow her, as in the pot that she's paying into, the same thing will apply in rather with the short-term employment as well.
Very good, very good. Carol, can I be included if I'm under 20,000 earnings? You can opt in, yes. I take it. Yep.
Yes, you can.
If Martin, maybe one for you. If I die in service, what happens to the pot?
That's the pot will become available to so auto enrolment will be similar to pensions. Pot will become available to the estate. That's my understanding in the event of death. Yeah.
Okay, very good. Thank you. Query there from Aaron. An employee turns 23 at some point in 2026. So there won't be 20, there'll be 22 on the 1st of January. Turn 23 at some point in 2026. Will they then be auto enrolled at that stage on turning 23?
On turning 23, yes.
Yes. Okay, thank you. Martin, Michelle asks, I'm in a private sector, moving to public sector. What happens to the pot?
If it's the auto enrolment pot, it stays, it remains invested in whatever funds that the choice that's been chosen or picked on. Obviously, no further contributions going in because gone into the public sector and they have their own pension facility. So there wouldn't be auto enrolment if they're in public sector employees, but the pension pot the auto enrolment pot they have remains invested and will continue to grow in line with the investment strategy and will be available at state pension age then.
Okay, thank you. Travel and subsistence is irrelevant to the A calculation. I take it's not. It wouldn't be for tax or PRSI purposes anyway. So I'm presuming it doesn't apply here either.
I agree with that. Yeah, it's not gross pay. Yeah,
it's not gross. Yes, that's correct.
Yeah. Okay. Question from Marie then. I opt out in month 7, 8, or my employee opts out in month 7 or 8. Who pays back the contributions?
Nobody. There is no refund in that situation. Okay. It stays invested and will continue to do so. And then within 2 years, he or she will be automatically re-enrolled for another 6 months where they can opt out again.
Okay. Mary, I just want to take up one of the things, it's my own question actually here that you said. So obviously there's been huge thing in the press here where, and you've stated it there at the end of your own that you can't put in your own scheme here that undercuts the employees but keeps them out of auto enrolment. Now, obviously Martin spoke before you and he spoke about the need to, looking at options here and all that. I presume if the option that Martin is putting to you to put to your employees is an enhanced version of auto enrolment, we've no difficulty here.
Can I answer that one?
You can indeed, Martin.
I can. I tell you why. I had, in fairness, Mary mentioned the minister's comments and the worry that employers were putting occupational pension schemes in place that was of little value and less value than auto enrolment for employees. I think anyone in the pension industry would have raised their eyebrows at that because, like, for example, a master trust arrangement, that's an occupational pension. Most of the pension providers have a minimum requirement of €100 a month. Now, €1,200 a month, if you have the standard earnings of 35,000 a year, you're looking at about 3.5%, which is well ahead. So, in other words, if the employer wanted to set up an occupational pension using the master trust and going with the minimum level of €100 a month, their contribution will be at 3.5% in that case, not 1.5%, be far greater. So there was a bit of like, how is that even being done?
I suppose it's fair to say, Martin, you would have to be really, really deliberately trying to undercut. It'd be very difficult to actually undercut AE as it currently is.
The minimum terms within most of these products, I'm not sure how you can undercut what auto enrolment is. Certainly from the conversations we're having with employers, we're saying to them, the minimum that we would see, is that the employee is no worse off. So the employer contribution, if you're doing an occupational pension or PRSA instead of auto enrolment, the minimum you should put in is 2%. 1.5% being the amount you would have put in under auto enrolment, and the other 0.5% being what the government will put in. So that the employee in that situation then has the 2% that will go in from the employer-employee. And we're saying to employers, that's the minimum. But most are looking at 3, 4, 5%. So well ahead of the level. So we were a bit confused about the minister's comments, really.
Okay. Very good. We often are.
I will say, though, that just to be clear, that we've been asked, and I have to say not by our own clients here, but I was at a conference where I was asked how you could actually sort of convince. So I think the WRC will be monitoring this piece of legislation and making sure that people are compliant. And non-compliance is just something that they will probably be honest throw the book at.
Yeah. Okay. Geraldine, this is an interesting one. Geraldine O'Brien, we often hire employees from outside of Ireland. From a look back point of view, how does this work to assess the 20,000 per annum earnings?
That's fairly straightforward in the sense that they will look back at the previous 13 weeks. And if your earnings are 5,000, there will be an assumption that over the year, it'll be 20,000.
Very good.
So if they've just come into the country, and the look back will start 13 weeks.
It doesn't have to hit the 20,000 before you're enrolled. If it looks and feels like you're going to hit 20,000, you're enrolled. Yeah.
Absolutely.
Okay. Karen Sykes then, regarding any employee who is exempt but chooses to opt in, does that then automatically start through payroll as soon as they opt in?
Yes, they will opt in via the portal. The portal will then inform NAERSA, and NAERSA will then instruct the employer.
Okay. If an employee wants to pay more than 1.5% in the first year, example 5%, does the employer have to match that 5%? I take it it's a no to that, is it?
My understanding at this moment, because this will be tweaked over time, but at this moment in time, it is 1.5% and 1.5%. Yeah. There's no option for an AVC either.
Definitely one for you, Mary, here, and this is from one of our colleagues, I think. Will ifac Payroll work with payroll clients to set up variable direct debits?
Yes.
Very good. Okay. Liam, if I join a company pension in January, can I leave auto enrolment the following month, or do I have to stay until June?
Say that again.
If I join a company pension in January, can I leave auto enrolment? So I presume it's an occupational pension. If I join a different pension to auto enrolment, can I leave it? So I'm opted onto it. Within the 6 months, I opt onto something else. Will I come out, or do I have to wait till the end of the 6 months?
No, because what will happen is as long as it's obviously through payroll, revenue will notify NAERSA. NAERSA will then the following month take you out of it, submit, instruct the employer to 0%.
Okay.
There'll be no, yeah, so there'll be no liability.
Okay. I think we're down to the last couple here. If employee currently pays a contribution, however, the employer doesn't, what happens in January 2026?
If it's done through payroll deduction, there's no auto enrolment requirement. If the employer is doing it separately themselves, the auto enrolment will come through on salary as well then.
So if your employee is paying a pension through
Let's say if they're
payroll.
doing it through payroll, yeah, and we have that situation where you can have an employer will have established an employer PRSA facility. So if the employee is paying through that deduction, then
with no company contributions at all.
No.
There's no cost then, but obviously that possibly would, if you're then now looking at starting to step that up with no employer contribution, that would probably fall foul of the rules here, I would expect.
Yeah, well, if an employer was to talk to us now about that and say, well, can we set up a PRSA? You can't force the employee to make a contribution to a PRSA in that case. So the employer isn't going to be able to say, well, we'll get around this by forcing the employee to make the contribution. And we would be approaching with the idea that you put in at least 2% into any PRSA or occupational pension facility so that the employee is no worse off. That'd be the take on that.
Okay.
And James, remember as well that this scheme is there to actually make sure you have a pension pot at retirement. So you are contributing to a pension. So that's fulfilling that need.
Okay. Carl, how do I work out how much to charge clients with this new increase? So is that probably passing on the cost to your customers, I take it as the answer there. And that's something we can work with you on. It'd be very straightforward to work out the cost of this scheme over the next 5-6 years as a percentage of your projected salary over that period. So yeah, Carl, that's fine. We can work with you on that. Anya, you mentioned the contributions are taken after 60 or 30 p.m. unpaid. That was is the employee or employer's contributions? Is this the employee or employer contributions? I'd expect both, Mary, is it?
Both. It's just like, you know how PRSI is deducted an employee and an employer contribution, and then it is paid via direct debit at the end of the month. It's same principle applies.
Okay. How do we go about setting up an occupational pension? Well, let's talk to Martin, I presume, is the answer to that one, Martin.
Yeah, so the conversation will come down to what sort of involvement the employer wants from a trust perspective. So there's two options. There's the master trust or there's a PRSA. The master trust is the part that brings in the opportunity for vested period, and that PRSA is very much the employees with the employer contributing to it. So it's a bit like auto enrolment. Whatever's contributed stays with the employer. It's in the employer's, or sorry, stays with the employee. It's in the employee's name. So it depends on the circumstances as to which suits best. We're having numerous, different people going different ways to suit their circumstances and their employee circumstances best. For example, I mentioned about the long-term service, 1.5 times salary. Well, then that's done under master trust, because that's where you access that. There's no point doing PRSA for that facility. So depending on the situation of the individual and the employee, that'll determine which route is best to sort it out.
Okay. Maura asks, an employee in a short-term contract to finish in June won't make the 20,000 by then, but will have made the 20,000 the previous year, and the person will then leave the country, do the pay. So I think we've answered that. If it looks and feels like they're going to hit 20,000 over a 12-month period, they're entered in. What happens to their contributions? I think that's been dealt with as well. It sits there, it's invested in what it's invested in, and it grows until retirement age. Anything to add on that, or is that pretty much it?
That's it from my perspective. Martin, do you know anything to add on that one?
Yeah, the only thing I'd add is we have seen and I've had conversation with employers that have staff, foreign based or source staff, and they are asking the question, like, what's the point? The staff are asking the question, we don't plan on being here for retirement, etc. An occupational pension that can be set up if you have existing staff, you cannot force them to contribute themselves to an occupational pension because you don't have it in the contract. Any new contracts, you'd recommend that's rectified and it's mentioned in any new employment contracts. But we have seen employers that are looking at making the contribution themselves, their own contribution, making the government contribution, and leaving it as an option for the employee. They still have the payroll deduction. But in some cases, a lot of employees are going, yeah, that's great because I wasn't interested. We haven't really talked about this, and it's not getting much mention yet, and I think it will in the new year. There's going to be a lot of employees just see this as an additional tax and an additional cost. The deduction is going to come out of their salary. There's not going to be any tax relief to reduce that burden. It's going to be raw and at the amount that it's at. And a number of employers are getting the question and query back from employees like, do I have to? How can I get out of this? So an occupational pension, we mentioned earlier, if you have a PRSA already in place and the employee is contributing and it's done through payroll, nothing else needs to happen. The same thing, if an occupational pension is put in place then for a staff member and the employer contributes at a no worse value, the employee doesn't have to contribute and no auto enrolment. So therefore they would evade that and avoid that 1.5% contribution for the employee as well. And for some foreign based staff or originally from different shores as such, that's how they prefer it. So again, it comes back to that: what suits the business best, and then what works best for the employees, and can those two be married, or what's the best solution within that? That's the conversation, really.
Thanks very much. I might just close with this one. Is there a maximum percentage contribution you can pay an employee through auto enrolment from 1st of January?
Is there a maximum?
Employer, I presume it's a maximum employer contribution that you can pay an employee. I'm presuming it doesn't say that, but that's what I'm assuming the question is.
No, first of all, we're going to be instructed by NAERSA, and it's 1.5 for employee and 1.5.
But if I'm on auto enrolment and I want to do more, is there an upper limit? Can I push it on beyond?
No, not at this
flexibility.
No flexibility.
Okay, so again, we're back to the benefits of looking at alternatives. Okay, thanks very much.
Bear in mind as well is that, like Martin alluded to, is of course you don't get the tax relief either. So that is something that one should consider.
Yeah. Okay. There is other questions in there, but I think just in the interest of time, we're at 5 minutes past 4, so we might just close it out at that. And I thank Mary and Martin for their time here today. If there's any more questions, or if we haven't got to your query, feel free to drop us a line. Our details are on the ifac website, and any of us here today, myself, Martin, or Mary, would be happy to link in and give advice separately here as well. So thanks to everybody again for joining. Thanks for speakers, and have a good evening, everybody.
Thank you.
Thank you. Bye.
Thank you.